Hello, and welcome to the Mortgage Solutions Masterclass, where we'll be reviewing the market changes that took place over the last year and discussing what it might mean for 2024. While it's not possible to predict everything, an understanding of what these events mean is invaluable for business planning and engaging with clients. I'm Shekina Tuahene, Commercial Editor at Mortgage Solutions.
And I'm Anna Sagar, Assistant Editor of Specialist Lending Solutions.
Thank you for joining us today. We're also joined by a panel of brokers who will be sharing their insights and expertise. So please welcome Greg Cunnington, Chief Operating Officer at LDN Finance and LDN Private Clients, Jodi Spreadbury, Senior Mortgage and Protection Advisor and Head of Lender Relations at the Mortgage Broker, and Karl Wilkinson, Founder and CEO of Access Financial Services. Thank you all for being with us. Also, at the end of the session, if time allows, there will be a Q&A portion, so please do share your questions using the box on your screens. So we will start with something that probably dominated the mortgage market this year, which is products and pricing. And it's so much so that it was in mainstream news and widely reported over there. So Greg, I will come to you first.
Great. In relation to mortgage products and pricing and how things impact. So nice big question to start with, which is always great. It's I think it's impacted the whole industry, hasn't it? And we can all see things there. If we go back to the kind of trust mini budget, which I appreciate was last year, there was some real volatility with interest rates. And what we noticed is when rates began with a 3, so when we went to high 3s, client perception was still actually okay. You know, the monthly payments were relatively affordable. The affordability calculation still kind of worked and things ticked along. This year, as things settled into the 5s, we noticed a real shift in kind of client perception in particular, where although the monthly payments were affordable, so in fairness to regulation, which I know is not always a popular thing to say, MMR had done its job because we certainly hadn't seen anybody have to hand their keys back in, but people did look at their new mortgage payments and just kind of go, ooh. And obviously how that's impacted things is it's really heavily impacted the purchase market, because if your remortgage was going up by £500 to £1,000, the last thing you're going to do is then borrow another 100,000 or 200,000 to move. So that's made people stay where they are for 12 months. The flip side, of course, is affordability, because with lenders having to stress test based on the pay rate plus typically about 3%, it means the amount people can borrow is a lot lower. So, you know, the days of 5.5 times salary have basically disappeared as a concept. And then also, and this is where I do feel for lenders, is that they all plead about margins being as low as they've ever been despite the higher interest rates. You know, how true that is, let's assume it is. But of course, it's meant there's been a massive focus from lenders, therefore, when it comes to pricing on retaining business, which has meant retention rates have typically been more attractive than new remortgage rates, which we're finally seeing a change of. And I know we'll come on to that in more detail later, but it does mean we saw a long period of a lot of product transfer business, which obviously is lower procuration fee, less chance of a broker fee. So that's really impacted things commercially as well for intermediaries.
Yeah. And Karl, I'll come to you next. What impact has this had on your business this year?
To be honest, it's been a very interesting year, as Greg has said. There's been a lot of ups and downs. I've noticed a lot of my brokers have actually diversified a little bit and have gone into protection, you know, heavily going into the protection side of things and, you know, trying to push other products as well. And to be fair, what's been very interesting is the 5-year fixed rates have actually been lower than the 2-year fixed rates as well. So it'll be interesting to find out how that's going to impact all of us, you know, in 2, 3, 4 years' time, because we're not going to have access to those clients as early as what we potentially could have had, you know, had the 2-year fixed rates been relatively lower. So, you know, we're not going to see, we've seen some of the impact already this year, absolutely, but we're going to see more of an impact, I think, over the coming 12 months, 2 years, 3 years time, when us as brokers are going to be looking to find out what can we do with our remortgage customers that we would normally have mortgaged anyway. So that's going to be interesting.
Yeah, thank you. And Jodi, in your view, what impact has it had on your business?
I mean, it's been a fun year, let's face it. Just the constant changing of rates and keeping an eye on them for clients has been almost double the work that we've been used to. So, securing somebody a rate of 5.5% and then checking a couple of weeks later and it's gone down to 5. It's great if they could afford it at 5.5, then the clients are happy with the lower rate when it becomes available. But especially if you're looking at remortgages 5 or so months ahead of the rate expiring, you could end up changing the rate 5 or 6 times before it actually goes live. Obviously, we will always be doing it because it's what's best for the customer, but you find you're on this constant cycle of an email's come in, rate changes, what does that mean and who have I got to change today?
Mm-hmm. And obviously it's had an impact on your business and the way you do things, but have you noticed the change that it has had on clients when it comes to affordability? So Jodi, back to you with that one.
Affordability has been a tough one this year because there's been a real balance between what people want to pay and what they can afford to pay. And I think there's been definitely with energy costs being so high, food costs being so high, people don't want their disposable income to be going on a much higher mortgage payment. We know that, like we said earlier, with MMR, the stress tests that lenders have put in place over the last couple of years have been there to safeguard people, to make sure people haven't been taking these huge mortgages when rates were 1 or 2%. With rates being 5%, it's still affordable, but a lot of people have the mindset of, I just don't want to be paying that extra payment. I think affordability definitely has been tightened by lenders a bit more this year, but hopefully we're not going to see too much pressure on that over the coming 12 months.
Yeah, of course. And Karl, what is your view on this?
I think from an affordability perspective, Greg touched a little bit on, if you're a first-time buyer, then you're just going to be a little bit more reluctant in buying that property. So the housing market has slowed down. I feel sorry more for homeowners because when they're looking to remortgage, and then all of a sudden with the cost of living and utilities going up, food going up, everything going up, they've now got to find that extra few £100s a month, to be able to remortgage. So it has been really, really tough. Even on the remortgage market, it has been really tough. And I feel for the homeowners who are now struggling because they've had to, remortgage this year at a much higher rate. How are they going to cope for the next 2 to 5 years? What's going to happen in the next 2 to 5 years? Because their expenditure has gone up massively on a monthly basis. So it is again, we're looking into 2024 a little bit, but I'm intrigued to see what's going to happen.
Yeah, definitely. And Greg, in your view, how has this affected clients, especially in the high net worth space too?
Yeah, so I think the issue we've seen this year is low interest rate environment was almost a drug that everybody got addicted to. And now having to take on medicine, it's not pleasant. So what we've seen are clients on good solid incomes, but not necessarily extraordinary, where they almost expect to have the Range Rover and the drive on car finance. They expect to do the really nice holidays. Suddenly both kids are at private school. And the issue there is you combine that with, as Jodi said, everything else going up in cost. But then if your mortgage payment is doubling, it's really tricky. And so we're finding with affordability, it's restricting borrowing for that reason. It's not just the increased stress testing. It's that combined with the PPC car finance, with the school fees. And it means, as you mentioned, in the high net worth space, we're seeing it quite common for clients on 6-figure incomes, where they can only borrow 3 times their salary. Whereas they come to you expecting to borrow 5.5, and get the house near the school they've had their eyes on for 4 or 5 years. So affordability has impacted the large loan space more than higher interest rates, in my opinion, because clients are struggling to get the borrowing or get used to having to change their commitments, which luckily with rates coming down in recent weeks, and obviously today's good timing because swaps have gone down quite nicely this morning, which everyone's really happy with. But there are a couple of lenders, and this is generally really fair play, are changing their affordability almost instantly when that's happening. So we're already seeing some slight tweaks where it's a bit better and clients can borrow a bit more. But I think the affordability challenge is something we'll all have to keep our eye on, because it's not going anywhere next year.
Yeah, and so it sounds like things might be changing, but this year the affordability constraint did see a shift to product transfers become a bigger part of the market. So do you think this will continue even though things might be easing? And what are the challenges around that? So Greg, I'll come back to you with that.
So there's a couple. The one thing we're noticing actually in the last month, I don't know if Karl and Jodi have seen the same, is lenders are finally pricing new business rates as competitively, if not better, than product transfer rates, which is instantly shifting more to remortgages, which I think is great, because with a remortgage, there tends to be more flexibility to change the repayment type. A lot of clients want interest only with the higher rates, extend the term, etc. And then also, and again, actually credit where it's due, a lot of the lenders have got much, much better at product transfers and been able to cancel and change rate. But we all know there are a couple where you can only do it, say, once. And that's a really tricky conversation right now, because if mortgage rates are going to come down another 0.3, 0.4 in the next 5 months, and we're discussing a May remortgage, is a product transfer of that lender the right option? So, yeah, that's where we're seeing a lot of the market at the moment.
Mm-hmm. And Jodi, what are you seeing with this?
Product transfers always used to be the easy option, and it's so important this year especially that full advice is given whether the client's doing a remortgage or a product transfer. It's not a quick solution, it's not an easy way out. It really is it the right solution for the customer? If the rates are competitive and it's the right thing for them, great. However, if a client's just doing a product transfer, then there's probably very little that's changed in their situation. And so many people over the last couple of years, especially with COVID and stuff like that, we see people who are separating, wanting to extend the term, take a chunk of the mortgage on interest only, borrow more because they need to change their home because they can't move because of the cost of rates. So it's very, very rare that a remortgage comes across my desk that's a complete bog standard, easy peasy product transfer is the best solution. But that those clients are getting clear advice and they understand exactly why we're giving them the option we are. I think that's going to continue next year as more and more remortgages or more and more rates are coming to an end. And it's so crucial that people are taking advice, even if they think sticking with their current lender is the best option.
Mm-hmm, of course. And Karl, in your view, what are the challenges around this? And do you agree that it will continue into next year?
Yeah, absolutely. I mean, to be honest, coming into next year, we will never ever see the low interest rates that we've all enjoyed for the last 5-6 years. I think we're gonna level off. We should be around about the 3.5-4% mark. I can't see us going below that. Product transfers coming in line with remortgages gives us the broker the opportunity to actually give proper full advice without the customer just jumping and making that decision. It is important that we do communicate with our customers to let them know, actually, let's do a full review. Let's make sure that this PT is definitely the best thing for you to do at this moment in time. The housing market, I think, has picked up a little bit as well, especially in the last month. Speaking to estate agents, they've come to me and they've actually said, I've had the busiest month I've had in 12 months, So there's a lot of confidence coming back in the housing market, especially with these recent rate drops. So I think it is looking positive, definitely, for next year.
Mm-hmm. And Jodi, I'll come to you with this one about the expectations for mortgage pricing next year. So Greg did mention that swap rates have gone down, and Karl has now said that estate agents are busy. So what do you think will happen with mortgage pricing, and what impact might it have on the market?
What do I think will happen, or what do I hope will happen? To be honest, I think even if rates just got down to early 4s and stuck there, it's the consistency that everybody wants and needs. When rates were 6.5%, everyone was tearing their hair out. But we all know that there are periods in time where 4 or 5% interest rates were just normal. These 1% and 2% rates, nobody thinks they're coming back anytime soon. and they were the anomaly. But because over the last 18 months we've had such up, down, the excitement of seeing a 3.99 earlier in the year, I almost thought, oh, have we got away with this lightly? And then having 6% back in the summer was painful. So I think regardless of what the rates are, as long as there's consistency without this up, down, that's where we're going to have some more stability and some more confidence in the market.
Mm-hmm. And Greg, do you agree that consistency is the preferable outcome rather than super low rates?
Well, no, super low rates would be amazing. But yeah, I completely agree with Jodi. I don't see us going back there. I do think it looks more by the day with all the economic data coming out like a rate drop should happen next year. And so the more that is priced in, the more mortgage rates should come down a bit. And I completely agree that if we can get to high threes, low fours, actually that's affordable. It makes the payments work. It makes affordability work. And also we're seeing similar to Karl. It's typical as it's coming up to Christmas, but the last month has quite noticeably been more active and busier. And we're hearing from a lot of our advisors, they're getting people get in touch for January. So although lenders are being quite pessimistic on lending data next year, rightfully so to be conservative, I think if rates continue to be stable and come down slightly, it could actually be busier than we're anticipating next year. And I also, just to add, think lenders will remain very competitive. If we are in a low 200 billion lending market, then obviously your big six and then your top 10 are going to really, really need to push to get new business in. And that environment should help keep mortgage pricing nice and sharp.
Mm-hmm. And Karl, what is your view on this?
Consistency is key. That's the only way that the mortgage market will actually continue, I think, at a decent level. Customers need to readjust. They need to reevaluate their affordability, and they can only do that once they know, what typically a mortgage rate is going to be, without a jump up to 6 or down to something else. So yeah, it looks like at the moment it's difficult to actually predict, but it looks like things are leveling off. The housing market is telling us that. Estate agents are telling us that there's a lot more confidence back in the housing market again. The houses are moving. So yeah, I honestly think that as soon as there's been a readjustment and customers have started to work out what they can and can't afford, and they've started to budget, I think we'll see a lot more happening. It'll probably, for me, I reckon round about Q2 next year, I think once that adjustment has happened, we'll start to see strength again.
Thank you very much.
And I'm just going to take over here briefly just to deep dive a bit more onto the buy-to-let side, which has been quite volatile with mortgage rates going up and with the landlord affordability being quite challenging. So I'll go to you, Karl, first about what has the buy-to-let market been like this year? Are there any areas that are kind of growing in popularity at all?
Oh, the buy-to-let market, hasn't that been an interesting year for landlords, to be fair? We've seen a couple of firms, actually brokerages, that have ceased this year because of the buy-to-let market. So it has been absolutely horrendous. I've seen landlords just sell. I've seen portfolio landlords who have just given up.
I think we might have lost you.
Hello?
Oh, Karl, you've come back now. Sorry, you just cut out a little bit there. But yeah, you were just basically saying the buy-to-let market's been horrendous, I think was your exact term.
Well, that's all I need to say, to be fair. Yeah. It has been horrendous. We've seen a lot of firms that have just ceased trading, a lot of brokerages that have ceased trading, some large ones as well. I've seen a lot of landlords, buy-to-let portfolio landlords, who have just decided to give up, and they're just selling their stock off, or they're selling half of their stock to put that money into the rest of the stock that they decide to keep. I've seen the smaller landlords with 1 or 2 properties who just can't afford to remortgage because the interest rates are so high, it's not profitable for them anymore. So that part of the industry has slowed down a little bit. Although saying that, I've also seen some, the multi-let side, it is what some buy-to-let landlords seem to be or have shifted towards. So your HMOs, your multi-unit properties, the development side of things. So the experienced landlords have started to shift a little bit towards that side of the market. So I've found with some brokers who are actually good at networking and do get out there and network, at property events, they've seen that shift a lot this year, definitely.
Interesting. Greg, do you have anything to add to that? Are there any kind of interesting dynamics in the market right now? Are there any kind of things like multi-lets that are kind of growing?
Yeah, it was reassuring because basically we've seen almost identical to what Karl described. So it's almost twofold for existing landlords. It's just product transfers. So a lot of our book is kind of accidental landlords in London and the southeast. So with those yields and with the rental income requirements, there is literally no remortgage option. But we are seeing professional, more experienced landlords actually still purchasing. Definitely a decrease. Buy-to-let was 20% of what we've done this year compared to 30% last year. Well, I think I saw the UK finance data yesterday it's at 7% for the market. It's still kind of slightly up. But we're seeing HMOs, student lets, very attractive because of the yield. We're seeing a lot of offshore and expat. So a lot of developers in London without Help to Buy are now going back to the old days of going to Hong Kong, Singapore, Dubai to sell their stock. That's all on a buy-to-let basis. And the big shift we've seen is nearly all purchase is now on a limited company basis, whereas it was more like 50-50. And also the sophistication of those limited companies. So it's not just your £70 off the shelf SPV. There's now typically layered structures. There's kids named on with 10% shares of the company, etc. So we're finding we're having to use lots of the more specialist lenders in that space to back up the structures landlords want to put in place.
That's really interesting. Jodi, what about you? Were you kind of seeing similar things to Karl and Greg here?
Absolutely, same across the board. I'm finding that a lot of the bigger portfolio landlords who have the reserves, the equity, they're not struggling as much, but a lot of people who have bought one or two properties, especially over the last 10 years, still high loan to values, not great rentals, they're the ones who have really struggled. Limited company inquiries definitely up. Nobody seems to think that buying in a personal name is sensible anymore. But I know that there are a lot of specialist lenders out there, and especially with what Greg was saying, put children on intercompany loans. There are so many more options now than there ever used to be. It's just whether clients can get their head around the pricing of those specialist lenders, and it's looking at it more as a long-term investment rather than a short-term, almost Del Boy make a quick buck solution that it was maybe 10 years ago, when you could buy cheaper properties and hope they were going to increase in value almost overnight.
That's really interesting. And also kind of on that pricing side, there have been more higher product fee, lower rate products just to kind of get around that pricing issue. How instrumental has that, or how helpful has that been in supporting landlords? I'll go to you first, Greg, on that. I mean, obviously you do more high net worth on that side, so is it helpful for that segment? Or
yeah, and it's obviously very helpful for London and the southeast, because with the pay rates you need the rate to be low to work. But I do think it's gone a bit too far. So I think some of the products with, say, up to a 3% fee, I can get my head around that. It blends the rate, it makes the borrowing work. When you've got some of a 7 to a 10% fee, I kind of just sit there and go, what kind of distressed purchase sale is this to make it worth a 10% fee? Surely it's something unlendable. And also we do a lot of specialist lendings. We've often helped a lot of landlords take bridging finance out on properties. And I look at it and go, pretty sure a bridge would be a lot cheaper than this if it's got a 10% fee. So yeah, they have been very helpful, and lenders who've made things work and been flexible and adjusted quickly, thank you. But 7 to 10% fees, I can't get on board with that.
What about you, Jodi and Karl? 7 to 10% fee, is that a step too far?
It just hurts. It's just unpleasant. The rental calculations, yes, it helps in the short term, but is it just kicking the can down the road? Because it just means in a couple of years' time, most clients, let's face it, are adding these fees, they're then going to have to look at rental calculations in a few more years' time for an even higher balance. We have got used to the sensible buy-to-let fees over the last few years, but there was a point, I don't know, 10, 12, 15 years ago where buy-to-let fees were high across the board, but I don't remember them being this high. These are painful.
Yeah.
It's interesting, isn't it? I mean, sorry, I was just going to say, it's easier to swallow on a smaller loan amount. So, you know, a landlord buying a property in Manchester up north, something like that, it's not so bad. But, you know, the further down south you go, the more ridiculous that fee actually becomes in money terms. And, you know, these high rates, all they end up doing, you know, is landlords increasing their rent, you know, so we just see an increase in rent happening over the coming months and years. But somebody's got to pay for it.
Yeah. And I mean, overall, I mean, it does seem like a bit of a bleak picture. But do you kind of expect buy-to-let? What are your expectations for the coming year? And what do you guys want to see from lenders if this kind of higher fee, lower rate isn't necessarily kind of ticking the boxes? I'll go to you, Karl, first.
There's still a lot of people out there, especially first-time landlords, second-time landlords. You know, it's always been a dream for a lot of people to own property. And I think that's been a big driver for a lot of people is like, you know, what do you want to do? I want to own a buy-to-let or one or two buy-to-lets. So there's always going to be that passion within the buy-to-let industry. And I think as rates start to come down in that market, we will start to see, you know, a positive shift towards more people buying. But again, you know, I can see rents going up, and that's the only way that you know these rental calculations are going to work. It might be that lenders start to introduce even more products that take into account their income, their employed or self-employed income as well. So again, 2024, I think, is going to be an upward shift and more purchase on that side of things. But yeah.
Greg, do you agree? Do you think that buy-to-let is kind of on a, you know, coming out of the slump a little bit going into next year?
Yeah, slightly. And I think obviously as rates get lower, it genuinely is really, really helpful. You had a lot of lenders with fantastic like-for-like remortgage products just before this increase in interest rates, where that's getting closer to working again, which would be great to open up more options. I think a lot of specialist lenders have made sure they've got product transfer options in place, which I know is tricky with the securitization in the background. So a big thank you there. In terms of what we would want to see in this space, Karl mentioned it, but for us, it would be top slicing. A big thank you to Barclays and Clydesdale, who do pure affordability on buy-to-let. And I generally say this all the time, but when I look at the landlords we put with those lenders, you're talking about kind of doctors, dentists, barristers. They're not going to go into arrears. You know, if they're £100 a month shortfall, I would rather they had it than somebody who doesn't work and just has two buy-to-lets, because then if they don't let them for 3 months, it's a tricky scenario. So I get there's a lot of compliance issues and lenders who feel it's a big risk factor. But actually, I think if you have the right controls in place and go for right clients, some more top slicing options would be great for the buy-to-let market.
Great. I'm going to quickly just jump ahead to later life lending, just because I am mindful of time. And I'll just direct the questions to Greg, who, as you've done more later life lending, and it's a bit more of your area of expertise. So obviously there was the FCA review earlier this year, which did identify some poor practice. I mean, what impact has that had, or if any, and what has the demand been like? Because there was obviously a bit, you know, lending has slumped a bit this year.
Yeah, so for context, we went into later life lending 3 months ago. So we set up an equity release Rio later life option. I spent 3 months setting it up and creating it. So I was very nervous and skeptical at parts for reasons like the FCA review. But actually what it's made me realise is, for a mortgage intermediary, we do everything on an advice basis correctly. So the trick is to be holistic and not pigeonhole, and not go, this needs to be equity release, this needs to be Rio. It's just take the client situations. And that's what the FCA review wants. So I think there is some scepticism that maybe there are some firms historically who have tried to steer people into equity release because of the higher procuration fees. But I think for mortgage intermediary, as long as we ignore that, it's certainly nothing we've seen, and actually it's been quite a good market. In terms of a clientele, what's been interesting, it's been a little bit build it and they will come. We haven't seen any of the kind of Coronation Street advert clients who want to borrow 20k to go on a cruise and have a nicer lifestyle. What we've actually seen is lots of clients from our own book and other firms who refer into us, where clients are 74, 75, coming to the end of their Halifax Barclays mortgage, they're at 15% loan to value, and they're getting their letter through the post saying you need to give the keys back and move out, and they're going, yeah, when I took the mortgage out when I was in my 50s, 74 sounded really old and I was going to go to a one-bed bungalow. But now I'm in the family home. I really don't want to leave. I don't see why I should. What options are out there? And so we're seeing a lot of equity release come in on that basis. And actually, it's been I think that's where the market will go. So you're correct that I think there's been 2 billion in the market this year. They forecast 6. So that's firms who rely on equity release, it must have been a really, really challenging year. But because we were a new entrant, actually it's been genuinely really interesting, and I think it will definitely be a growing area. And also because obviously the way it works, the interest rates are really important to how much borrowing a client can get. So we've already seen now rates are more around the 5% mark, whereas only 3 months ago they were more like 7%. That's made a really, really significant positive impact to that marketplace as well.
And I mean, there has been, I know L&G came out with a hybrid lifetime mortgage, which is kind of targeting the demographic you're sort of speaking of like, actually they're a bit younger, they're, and that kind of thing. Do you think there needs to be kind of more of that kind of innovation on the market?
Yeah, agreed. I think that's a great product. I think Livemore do something similar as well, where you can almost start on a normal mortgage, move to RIA, and then move to equity release. And I think that's great. And it doesn't even need to be innovative with one lender. It's more, you've got lenders, like a big shout out to people like Family who'll go to age over 100 normal mortgage. You've got great RIO lenders. I think it's more for the intermediaries to know all of the options in those spaces. But exactly that, it's not just put somebody on a mortgage and go, right, it's done. It's reassess every year and see, should it now go to RIO, should it now go to equity release? And definitely that kind of holistic and innovation is what's needed.
So I'm kind of getting cautious optimism for the year ahead. That's the kind of vibe I'm getting.
Great phrase, exactly that. Yeah.
Shekina, I'll hand back over to you to dive into Consumer Duty next. Leave the best till last.
Thank you. Yeah, the good compliance chat. So yeah, Consumer Duty came in this year, and there's a lot of build up before it did, and discussion around how it will change the advice process, the services offers, and just the way we would interact with clients. And so what has implementation been like, and what preparations are you making ahead of the first reporting deadline next year? So Greg, I will come to you with that question first.
Yeah, thank you. I think it was an interesting one because, again, actually, when you look at the ethos of Consumer Duty, I quite like it. But it was hours and hours and hours and hours of work in my life, so I didn't like that. But I think the main thing it struck me is, first of all, and we should all actually be quite proud of this, I think mortgage intermediaries will probably as close to it, way more so than most other areas of financial services, because we do put the client first. What we found is the trick is evidencing it. So we know we do it, we know our advisors do it, we observe them, we hear it, it's our culture, you see it in your reviews. But I think what Consumer Duty did is say, yes, but a bit like Ofsted at school, if the FCA come in tomorrow, how are you evidencing it? What is your thought process? And I think what we all found tricky is typical regulator, they didn't prescribe that. So they said, no, you show us what you think, and then we'll tell you if it's good or not. So none of us actually know if we've got this right. We'll find out over the next couple of years. But we've seen as a positive, and all it did is put some structure and clear guidelines into place. The one thing it did change was our fee structure, which previously we've got 23 advisors, and it used to be, could you really say hand on heart, if a client walks through the front door, the fee does not change depending on which LDN advisor they see? I probably couldn't say that hand on heart. Whereas now it's clearer, there's guidelines, clients know exactly what the fee structure is. And what was interesting when we went through that process is it meant we were proud of our fee and we stuck to it. And it was good to hear the advisors say that. It meant we've changed our product transfer fee, obviously to be lower, typically free, but also more specialist parts of the market, like limited company, buy-to-let, offshore. We actually increased our fee on the back of our research into Consumer Duty. So strangely, there was a commercial element as well of increasing fees. and actually explaining to clients in clear guidance why that is the case and why it is more complicated. So yeah, hours of work. Hopefully we've got it right. We'll all find out in the next couple of years, but genuinely some positives to it as well.
Yeah, so it sounds good and like you're on the right track so far. And Jodi, what has your experience been like?
So we've always been part of a network, which means we've always really had quite strict guidelines to follow. With Consumer Duty, we knew that there was these new rules coming in, but thankfully we were already pretty much at that level. So a few tweaks here and there. Thankfully, unlike poor Greg, who's done hours and hours and hours of work on this, a lot of our feedback and guidance came directly from our network. So I want to say it was made relatively easy for us. A couple of changes, a couple of tweaks throughout the year, just to make sure that we are all at that standard. I think Consumer Duty, does anybody like compliance? No, but if it means that some rogue advisors within the industry that weren't doing things up to scratch have been brought up to a better level, it's just better for clients across the board. So if a few firms have had some wrist slapping, so be it. But ultimately, we all want what's best for clients.
Mm-hmm. And Karl, I know that you're directly authorised, so you also would have had a bit of a hands-on process. So how has that been for your firm?
To be fair, we've always put the customer first anyway, and I think Greg and Jodi have touched on that as well, is that if you're a firm that actually did truly care about that customer, truly put that customer first, then there's not a lot of change that you would really need to do for Consumer Duty. We've all, we all look after the customer, and all we needed to do from an FCA perspective is just make sure that we're falling in line with what the FCA expects of us, and making sure that actually, yeah, we do that, and that's where it fits within the FCA's guidelines, and we do that, and that's where it fits. So it's more or less aligning what we already do with what the FCA expect from us as a firm. So there hasn't really been a lot of change within Access. It's been more about just making sure that we're aligned. We'll all know, though, in the next couple of years, as Greg said as well, let's see what the FCA do actually expect from us. But I wholeheartedly embrace Consumer Duty and what it means and how important it is that we communicate to the customer and make things clear and make sure that they're getting the best possible service.
Mm-hmm. Of course. And now we have gone over what's happened this year, so we'll look forward. Karl, I'll come to you with this first. What is your aim for the year ahead, and what do you think the challenges will be?
My aim for the year ahead and challenges, I think we've all sort of hinted at saying, yes, optimistically, things are going to get better. For me personally, for Access, it's working with my brokers to make sure that we do offer a complete suite of products to the customer. We need to try and work out how we can increase the earning potential of our brokers as well. And we've all got to make money at the end of the day. The market will slowly improve, but there's still a lot of brokers out there who aren't earning what they were earning the year before, who need help and support to get to the levels that they're used to earning. So 2024 is a project, really. It is looking a lot more positive than 2023 already. So I think it's going to be a good year. I honestly think it's going to be a good year. Not the best, but it's getting there.
Yeah, well, that sounds positive on the whole. And Jodi, what is your plan or outlook for the year ahead?
The plan is to survive it like we've done this last one. I think just being proactive, don't react to what's happening in the market. Be on top of it with clients, make sure they fully understand what's happening and give them sort of as much notice as possible when rates are coming to an end. Protection, I think, is just going to be so important. It has been very important this year with clients extending terms, changing the dynamic of their mortgage, and just generally with cost of living being so high, having protection in place is now so important, because if you do end up with a month or two of no income, that's going to put a lot of pressure on people financially. So yeah, working really hard with our advisors to make sure they are as knowledgeable across the specialist market, because I think that's going to be quite an important one for next year as well, and that they're all up to speed on protection.
Mm-hmm. Thank you. And Greg, lastly to you, do you have any outlook for the next year, and what are your plans?
Yeah, so as before, I found myself nodding and agreeing with pretty much all of that from Karl and Jodi. I mean, I think the elephant in the room this year has been really challenging. I've been in the industry for 17 years, and not in terms of volumes have actually been okay, but just in terms of how difficult and challenging the year has been for mortgage intermediaries, I think this is right up there. But I think it's a case of next year now, rates are getting in a better place, lenders are still in a really good place, so it's being as set up as we can be to do as well as we can next year, because I think the market actually is going to be better than people think. I think by Q2 we might be looking in a good place. And it's about looking for the areas of the market you want to work in. I think we've all kind of fed on nice vanilla residential mortgages for a few years now, which is fantastic. But actually to really, really do well now in this industry, I think you've got to look at other areas. So whether it's professional landlords, more specialist lending, high net worth, which is a big part of what we do, and equity release. I think it's about having a couple of areas you want to specialize in as well and really mastering them. And then also it's a bit old school, but it's about actually kind of looking after your clients and staying in touch. The days of speaking to somebody who goes, yes, I want a mortgage, here's the rate, and they do the application 2 days later. Obviously we all love those and get them. But we're finding a lot more of clients where maybe they don't transact for 3 months, 6 months, 9 months, 12 months. So it's making sure we have the systems in place and actually doing a bit of the old school part of the job and staying in touch with these clients to make sure you're still seen as their advisor kind of when they do look to move forwards.
Thank you all very much. And we do have a couple of minutes for 1 or 2 questions. So the first one, and anyone can take this, would be how regularly should brokers review their business outlook, and should it be dependent on market changes, or should it just be periodically looking at how things are going? Does anyone want to take that?
I think it depends on the size of your business. So business our size, we do a kind of board meeting monthly where we just talk about the next 1 year, 2 years kind of strategy. But 100% you have to be agile. You want long-term plans in place. But as an example, I reckon we probably all came in January this year and went, right, here's our growth plan, here's the money we need to spend, here's the staff we need to add. And then by June, we're like, we're not doing any of that. So we need to change plans very quickly and be a bit leaner and a bit more agile. So really, really important. I always like to call it staring out the windows time. And I say it to my CEO all the time, so we're both quite hands-on. I say sometimes actually when you're running a business, you need to find time in your diary to just stare out the window for 2 hours, because I'm sure we've all had that where you go on holiday and suddenly you've had the best business idea ever. And it's because you're thinking about the strategy, not just how busy operationally you are. So yeah, that would be my advice.
Yeah, I think also I'm going to quote Abraham Lincoln, but he said, give me 6 hours to saw down a tree and I'll spend 4 hours sharpening the saw. So the idea is that I think it's really important for brokers to actually take a little bit of a time out from trying to get that customers or those customers to strategize and to think about what is actually happening in the market. Do I need to maybe concentrate on specialist lending or something else, learn a little bit about maybe where they want to go and then get back into it. Jodi and Greg also mentioned about it's the proactive advisors that are the ones that are successful, and proactivity is key. Staying in touch with your customer is crucial, 100%. It doesn't hurt to go back to your old customers and just ask for referrals and ask for recommendations and see how they're doing. They might just turn around and say, oh, actually, I was chatting to my neighbour the other day and he wants X, Y, Z. So it doesn't hurt, to actually step back, have a think about where you're going, what you want to do for 2024. And, at least you've got a target and you've got a direction to go in.
Yes, of course. Thank you. And
we've got a question just come in. Excluding rates, what is the most important thing you feel is needed from lenders next year to assist your clients and advisors? And I think we've kind of touched on it a bit, but just to kind of recap, I suppose. Jodi, do you have anything to add to that?
Aside from rates, just generally being open with their criteria. And we have surprisingly seen a lot of lenders still be really, really lenient with their criteria over the last 12, 18 months, which with the pricing, it could have gone the other way. I mean, we all remember the point in COVID where suddenly you couldn't get a mortgage for somebody who was self-employed for a period of time. You couldn't get a mortgage on a new build for a period of time. Having options for smaller deposits, I think we were talking about this the other day, Anna, where there are so many options for people to buy with smaller deposits now than there ever has been. So just the availability of options to customers across the market, I think is really important, regardless of rate. You know, if someone wants a mortgage with a 5% deposit and a bit of bad credit, and there is an option for them, you know, they'll potentially take it, even if the rate isn't the best, because they have the choice to be able to buy their own property, which may not have been an option if criteria was harsher.
Yeah, that is, I think it's a good wish list to have, I think. But I think that is all we have time for. Thank you so much for joining us, and we hope you found it engaging. And thanks to Jodi, Karl, and Greg for taking part as well. And we hope you have a lovely rest of the day and happy holidays. Thank you so much. Goodbye.
Happy holidays.